Welcome to today's session, Introduction to Technical Analysis. This is one of the most exciting turning points in your journey as a trader or investor, because from this point forward, you'll start seeing the market not just as numbers, but as a language. Charts may look intimidating at first, all the lines, candles, colors, but when you learn how to read them, they begin to tell you a story. And that story is built on one thing, price. Price is the market's raw, unfiltered opinion. It doesn't lie. It doesn't make excuses. It simply reflects the push and pull of all market participants, buyers and sellers, bulls and bears, institutions and retail, all making decisions in real time. Technical analysis is the art and science of learning to read that price, to understand how and why it moves, where it's likely to go next, and how we as traders can respond with confidence and discipline. In this session, we're not just learning tools, we're learning how to see the market in a new way, a way that puts us in sync with momentum, trend, and structure instead of guessing or hoping. So let's jump in and begin building that foundation. Before we dive into charts, indicators, and patterns, let's take a moment to set the roadmap for where we're headed in today's session. These are our 5 core learning objectives, the key outcomes you'll walk away with by the end of this lesson. First, you'll develop a clear understanding of what technical analysis is and how it differs from other approaches like fundamental analysis. Second, you'll learn how to identify key concepts like support and resistance, trend lines, volume, and moving averages, which are the building blocks of chart reading. Third, we'll explore basic chart patterns and popular indicators like RSI and MACD, not just what they are, but how to actually use them in context. Fourth, you'll get a sense of how TA can be used across different trading styles, whether you're a short-term scalper or a long-term investor. And finally, you'll start to build the right mindset for technical trading, learning to observe price action without bias, react with discipline, and avoid some of the most common traps that new traders fall into. These are the tools that will serve as your compass moving forward. Let's get started with a deeper look at what technical analysis actually is. So let's start with a clear definition. Technical analysis, or TA, is the practice of studying price and volume data to forecast future price movements. Instead of looking at a company's earnings, debt, or industry trends like you would in fundamental analysis, technical analysis focuses solely on what's happening on the chart. The core assumption is this: all known information, earnings reports, news headlines, even investor sentiment, is already priced in. What matters now is how that price is behaving. Is it trending higher? Is it bouncing off key levels? Are buyers or sellers in control? Technical analysts look for repeatable patterns, areas where price tends to react, hesitate, or break out, because behind every candlestick is a decision to buy, to sell, or to wait. So why does this matter? Because the market doesn't reward opinions. It rewards alignment. TAG gives you a real-time view into the psychology of the market, how people are acting with their money. You don't need to guess if a stock should go up. You can see whether people are buying it now, and that's powerful. It gives you structure. You can spot where support is holding, where resistance is pushing back, and where volume is confirming or denying the move. Whether you're day trading, swing trading, or even investing for the long term, technical analysis gives you tools to time your entries, manage your risk, and exit with clarity. So instead of just saying, this is a good company, you're now asking, is this a good price to get in? And is the chart backing that up? Now, let's talk about how different people view technical analysis. First, there's the trader's perspective, which is probably what brought many of you here. Traders aren't trying to predict the news, they're trying to read the reaction. If buyers are stepping in at a level 3 times, a trader sees that as significant, whether or not CNBC is talking about it. Then there's the skeptic's perspective. Some say TA is like astrology for finance, just a bunch of lines on a chart. And honestly, if you use it without discipline, context, or understanding, it can be, but used correctly with proper risk management, TA becomes a lens, not a crystal ball, that helps you make smarter, more informed decisions. Finally, there's the strategic perspective, the one we'll embrace in this course, where TA doesn't have to replace fundamentals. It can complement them. If you like a stock long-term, technical analysis can help you choose a better entry point. If you see momentum building in a sector, TA can help you ride the wave without being late. Bottom line, technical analysis is about being in sync with what the market is actually doing, not what you wish it was doing. And once you learn how to read that behavior, you'll never look at a chart the same way again. Now that we've defined what technical analysis is, let's look at one of its most important components and one of the most overlooked: price action. Price action simply refers to how price is moving on a chart, candle by candle, tick by tick. But beneath that movement is something far more important: emotion. Think about it. Every trade placed is a decision. A buyer believes price will rise. A seller believes it won't. Multiply that by millions of trades a day. And what you see on the chart is not just price, you're seeing collective emotion. When a stock spikes and then instantly pulls back, that might be FOMO followed by doubt. When price grinds sideways with long wicks and no real direction, that might be confusion or lack of conviction. And when price breaks out cleanly on rising volume, that's confidence. Learning to read price action is like learning a new language. You're asking, who's in control right now? Are they getting stronger or weaker? Is this move real or emotional noise? But it also forces us to turn the lens inward, because we're not just reading other people's emotions, we're confronting our own. How often have you hesitated to enter a setup you saw coming only to chase it after it already moved? That's emotion. How often have you held a losing trade longer than you should have, hoping it would come back? That's emotion too. The more you study price action, the more you begin to build emotional distance. You stop reacting, you start observing, and you realize the chart doesn't care about your opinion. It simply tells the truth, candle by candle, move by move. Your job is to listen. One of the most important and most widely used concepts in technical analysis is support and resistance. These levels act like invisible walls on a chart, places where price tends to stall, reverse, or break through. Let's start with support. Support is the price level where buyers step in. It's a floor, often psychological, where traders see value and start buying. Imagine a stock falling to $50 multiple times, and each time it bounces back up. That tells you buyers consistently defend that level. That's support. Now, flip it. Resistance is the ceiling, a level where sellers take control. Price reaches a point, but struggles to move higher because people start taking profits or shorting. Support and resistance levels aren't just about logic, they're about memory. They reflect past behavior. Price struggled here before, so it might again. And here's where it gets interesting. When price breaks through support or resistance, that level often flips roles. What was once a floor becomes a ceiling. What was once resistance becomes new support. This is called a role reversal, and it's a powerful confirmation when combined with volume and structure. These levels matter for two key reasons. First, they help you plan trades. If you're buying near support, you can set a tighter stop just below. If you're targeting a resistance level, you know where to start reducing risk. Second, they show where trader psychology is clustering. Think about it. If thousands of traders saw price reverse at $120 multiple times, that level becomes baked into their decision making. So when price comes back to $120 again, everyone's watching. Maybe they're scared to buy higher. Maybe they're waiting for a breakout. Maybe they're already in and looking to take profit. This creates predictable behavior. And as a technical trader, your job is to recognize it and plan around it. Just remember, these aren't exact numbers. They're zones. Think ranges, not pinpoint prices. And the more clean touches you see, especially on higher time frames, the more likely that level is meaningful. Support and resistance are your map. They don't tell you everything, but they tell you where to pay attention. As a trader, you want to be able to identify structure, the underlying shape of a chart that shows you where momentum lives. That's where trend lines and channels come in. A trend line is a simple tool, just a diagonal line connecting swing lows in an uptrend or swing highs in a downtrend. But don't let the simplicity fool you. Trend lines can reveal a lot. When price respects a trend line multiple times, it shows that buyers or sellers are defending that level with conviction. A rising trend line tells us buyers are stepping in at higher and higher prices. A falling trend line says sellers are dominating and buyers are afraid to step up. And then we have channels, two trend lines working together, one on top, one on bottom, forming a kind of price corridor. Channels help you identify where price may move next, as well as when it might be breaking out of its usual behavior. For example, if a stock is bouncing in an upward channel and suddenly breaks below with strong volume, it might signal a shift in trend or a possible pullback. On the other hand, if price breaks out of the top of the channel and holds, it could be a sign that momentum is accelerating. Here's what's key. Trend lines and channels are dynamic tools. Unlike horizontal support and resistance, they move with the chart. That makes them especially useful in trending markets because they give you reference points to evaluate continuation versus reversal. One common mistake is trying to force trend lines to fit. If you have to bend the rules or ignore wicks to draw a trend line, it probably isn't valid. Let the chart tell you where the trend is, not the other way around. And remember, the longer and cleaner a trend line or channel, the more significant it is. You can use them to plan entries, exits, stop placements, and most importantly, stay in alignment with the current market direction. Technical analysis isn't to guess where price could go, but rather to identify structured trends. Charts can feel overwhelming when you're new, all those lines, indicators, and patterns. But at the heart of every technical chart is the most important unit of all, the candlestick. A candlestick tells you exactly how price moved during a certain period, whether it's a minute, an hour, a day, or a week. Let's break one down. Each candle has a body, which shows where price opened and where it closed. If the close is higher than the open, it's typically green, showing bullish movement. If the close is lower than the open, it's red, showing bearish movement. Then you've got wicks or shadows sticking out above and below the body. These tell you the highest and lowest prices reached during that session. Just from that one shape, you can begin to answer a powerful question: who was in control? Was it a clean bullish move, strong body, little resistance? Or did price try to rise, get rejected, and close near the low? A sign of hesitation or reversal? That's where patterns come in. A hammer, small body with a long lower wick, might show sellers tried to push price down, but buyers came in and slammed it back up. A doji, where the open and close are nearly equal, tells us there was a tug of war, and no side really won. An engulfing candle tells us one side was so dominant that it completely overpowered the previous candle, often a sign of momentum shifting. But here's the key. A candle is never just a signal by itself. Context matters. A hammer at support means something different than a hammer in the middle of a range. That's why learning to read candles is a skill, not a checklist. You're not memorizing signals. You're learning to read behavior, told through price. And once you slow down and study candles one at a time, not just chasing setups, you start to see how traders behave under pressure, how momentum builds, and how emotion leaves a footprint. Every candle is a conversation between buyers and sellers. Listen. So far, we've talked about how traders read price through structure, levels, and candlesticks. But now, we add another layer, something that adds depth and conviction to what we're seeing. That layer is volume. Volume tells us how many people or how much capital is participating in a move. And here's the rule of thumb. A move that happens with high volume is more likely to be real. A move that happens with low volume is more likely to fade. Why? Because volume represents interest. If a stock is breaking out above resistance, but nobody's buying with size, that breakout may not hold. On the other hand, if volume spikes as the breakout occurs, that's a sign of conviction. Volume is like applause at the end of a play. Did the crowd feel it, or did they just watch quietly and move on? You'll often see this in patterns. A triangle breakout with surging volume equates to go time. A hammer candle with no volume might just be noise. One thing to keep in mind, volume is relative. What counts as high volume for AAPL isn't the same for a small biotech stock. So compare current volume to a stock's average volume, usually over 20 days, to see if it's above or below normal. You can also spot volume divergence where price is making new highs, but volume is falling. That's often a clue that momentum is slowing and a reversal might be on deck. Volume also shows up at key turning points. Big green candle off support with rising volume might show you that buyers are defending this area. Sudden red candle with massive volume at resistance might tell us that institutions are selling. Volume doesn't predict, it confirms. It's not a crystal ball, but it's a lie detector. When you use volume alongside candles, trend lines, and levels, your analysis gets stronger because now you're not just asking what is price doing, you're asking who's behind the move and how committed are they. So far, we focused on raw price movement, candles, levels, trend lines, and volume. But now we're going to add a tool that helps us filter the noise and see the bigger picture. That tool is the moving average. A moving average takes the last X number of price points, say 20, 50, or 200, and averages them out. It creates a smooth line on your chart that helps show the overall trend direction. And there are two main types, the simple moving average, or SMA, which gives equal weight to all price points, and the exponential moving average, or EMA, which gives more weight to recent prices, making it react faster to changes. The benefit? These lines help you avoid getting whiplash by short-term price swings. Let's say price is spiking and dipping all over the place, but the 50-day moving average is still climbing steadily. That tells you the trend is still intact, even if there's volatility along the way. Moving averages can also act as dynamic support and resistance. Price will often bounce off these levels, especially when other traders are watching the same. This makes SMA part of what we call self-fulfilling technicals. Because so many people use them, their influence becomes real. One powerful concept to know is the crossover. A golden cross happens when a short-term SMA like the 50 crosses above a long-term SMA like the 200, a bullish sign. A death cross is the opposite, often a signal of a bearish shift. And remember, different SMA work better for different time frames and strategies. Short-term traders might use a 9 or 20 EMA to stay close to the price action. Swing traders might rely on the 50 or 100 SMA to ride broader trends. Long-term investors often track the 200 SMA to define bull versus bear market structure. Here's your takeaway. Moving averages don't predict the future, but they reveal structure, and structure helps you stay aligned with the trend. And as we've said before in this course, trend is not just your friend, it's your edge. As traders, we're always trying to read the market more clearly, to filter noise and identify signals. That's where indicators and oscillators come in. Indicators are mathematical tools based on price, volume, or both that help us interpret trend strength, momentum, volatility, and potential reversal zones. Now, before we go any further, here's something critical. Indicators are not predictive. They don't tell you what will happen. They're just tools. And like any tool, they only work well when used in the right context. So let's look at a few of the most commonly used ones, starting with the RSI, or Relative Strength Index. The RSI is an oscillator. It moves between 0 and 100. Typically, RSI above 70 signals overbought. RSI below 30, oversold. But just because something is overbought doesn't mean it will instantly reverse. Stocks can stay overbought for days or weeks in a strong uptrend. What RSI tells you is, hey, momentum might be stretched here. Start watching closely. Then there's the MACD, Moving Average Convergence Divergence. It's made of two moving averages and a histogram that shows the distance between them. When the MACD line crosses above the signal line, that can show bullish momentum building. A bearish cross, potential weakness. The MACD also helps you spot divergence. When price makes a new high, but the MACD doesn't confirm, that's often a sign momentum is fading. We also have tools like the stochastic oscillator, which compares a stock's closing price to its recent high-low range. It's helpful for spotting short-term reversals, especially in uncertain markets. And finally, one of the most visual tools, Bollinger Bands. These bands expand and contract based on volatility. When they tighten, called a squeeze, price is often building up energy for a breakout. Here's how to use indicators. Well, start with price, always. Then ask, is momentum confirming what I'm seeing? Is this breakout supported by volume or MACD? Is RSI flashing a warning before I chase? Use indicators to confirm what you already see, not to convince yourself of something you want to believe. Because in trading, confidence comes not from certainty, but from alignment. When structure, price, and indicators all point the same way, that's where your edge lives. One of the most fascinating aspects of technical analysis is how often the same behaviors repeat in every market across every time frame. That repetition shows up in the form of chart patterns. These patterns are like visual footprints left behind by collective behavior. Fear, greed, hesitation, confirmation, all playing out over and over again. Let's break a few of the most important ones down. First up, head and shoulders. This is a classic reversal pattern, either at the top of a trend or inverted at the bottom. You have a peak, the head, flanked by two smaller peaks, the shoulders, with a horizontal level below, the neckline. Once price breaks that neckline, it often signals that the trend has exhausted. Next, double tops and bottoms. Price tests a level twice but can't break through. This shows that buyers or sellers are running out of steam and often leads to a reversal. Then we have triangles, ascending, descending, and symmetrical. These patterns form as price consolidates and the range tightens. Breakouts from triangles often happen with volume spikes and can go either way, continuation or reversal, depending on context. A cup and handle pattern forms after a rounded pullback, followed by a shorter consolidation. The breakout often signals strong bullish continuation. And finally, we have flags and pennants, short-term continuation patterns that form after a strong move. Price pulls back or drifts sideways, volume contracts, and then boom, the trend continue. Here's what makes patterns powerful. They give you structure. You know where a breakout might occur. You know where to place a stop. You can even project a target based on the height of the pattern. Effective patterns need volume confirmation, trend context, and sometimes indicator support to validate what you're seeing. Once you understand how patterns form, you can stop chasing and overexposure. A very confusing and important thing to understand about technical analysis is that everything depends on the time frame you're looking at. A stock can be in a bullish uptrend on the daily chart, but look like it's crashing on the 5-minute, and both can be true. That's why learning to use multi-time frame analysis is a must. So what does that mean? Every chart you look at, whether it's a 1 minute or a monthly, represents the same asset, but through a different lens. The shorter the time frame, the more detail, but also more noise. The longer the time frame, the less noise and more structure and reliability. Let's say you're a day trader. You might use the daily chart to see the broader trend, then drop down to the 1 hour chart to find a setup. And finally, use the 5 minute chart to time your entry. That's called a top-down approach, and it helps you stay in sync with the market instead of getting chopped up. Why is this important? Because many new traders make the mistake of zooming in too far. They take a breakout on the 5 minute chart, only to realize they were trading directly into resistance on the daily, or they see a reversal candle on the 1 minute. And forget the daily chart is in a powerful uptrend. Multi-time frame analysis helps you ask better questions. What is the bigger picture trend? Am I trading with or against that trend? Is this a high probability entry, or am I front running structure? Every professional trader uses this technique. Why? Because it creates alignment. When your short-term setup matches the longer-term trend, that's where conviction comes from. It's like lining up multiple signals in the same direction. So the next time you take a trade, zoom out before you zoom in, because price may be whispering on the 1 minute, but it's yelling on the higher time frames. All the chart patterns, indicators, and strategies we've covered so far are powerful, but they mean nothing if you don't have the right tools to see them clearly and act on them quickly. That's where this slide comes in. Your tools of the trade. Your setup should do two things: help you interpret price behavior with clarity, help you execute with speed and confidence. Let's start with charting platforms, because this is where your analysis begins. TradingView is one of the most popular platforms out there. It's browser-based, has hundreds of indicators and other features such as replay functionality, great for beginners and advanced traders alike. Thinkorswim by TD Ameritrade offers more customization and is especially strong for options traders and complex strategy layouts. TrendSpider is great for automated analysis, things like auto trend lines, back testing, and unique features like raindrop charts. Then you have execution platforms, or what is called your broker interface. Tools like Webull, TD Ameritrade, and Interactive Brokers give you trading capabilities across stocks, ETFs, and options. Some traders also make use of tools like screeners and scanners, sites that can help you find setups based on volume, patterns, and fundamentals. But here's the most important point of all. Your tool is not your edge. It's just an extension of your process. The best charting software in the world won't help if you're unclear on what you're looking for. So start with clarity and then build your toolkit around that. One charting platform, one broker, one scanner. Get to know them well, set alerts, create templates, practice your flow, and over time, your tools will stop being a barrier and start becoming an asset. Throughout this lecture, we've started to touch on initial technical analysis like reading price, trend, structure, and momentum. But now it's time to zoom out and place that within the bigger picture of trading and investing. We know TA isn't the only tool in the shed. The other major approach is fundamental analysis. So what's the difference? Fundamental analysis tries to answer the question, what is this company really worth? It looks at financial statements, earnings growth, profit margins, leadership quality, competitive advantages, macro trends, all in an attempt to evaluate whether a stock is under or overvalued. On the other hand, technical analysis doesn't ask why. It asks, what is price doing right now and how are people reacting to it? TA assumes that all known information, earnings, forecast, sentiment, is already priced in. So rather than predicting what should happen, TA focuses on observing what is happening. And here's the real key. Neither one is better. They're simply answering different questions. Traders often lean on TA for short-term decision-making, entries, exits, stop loss zones, breakout setups. Our investors lean on FA for long-term conviction, building portfolios around solid, growing businesses. But the sweet spot, that's when you learn to combine them. Or let's say you believe in a company long-term, great fundamentals, strong sector, smart leadership, but instead of buying right away, you check the chart. If it's trending down, maybe you wait for a base to form. If it's testing long-term support on volume, maybe that's your moment. In this way, TA helps you fine-tune your fundamentals. It turns you from someone who buys whenever they feel bullish into someone who enters with precision, aligned with both story and structure. Because ultimately, every great decision maker in the market isn't just a technician or just an analyst. There's someone who knows how to see the full picture and act accordingly. This is where it all comes together. For this week's assignment, you're going to pick a real chart, stock or ETF, and apply everything we've covered. You'll mark trend, draw levels, identify patterns, and layer on volume and indicators to develop a full technical perspective. More than just checking boxes, the goal here is to train your eyes. When you annotate a chart, you start to slow down. You start to see where prices reacted and where it might go. You'll also propose a trade idea, even if you don't take it. This helps you build the habit of linking your analysis to real decisions. Where would I enter? Where would I protect myself? Where do I believe price could reasonably go? And finally, I want you to reflect. Did charting make the move clearer? Did volume, structure, or RSI add confidence or raise questions? Trading is a skill, and the only way to get better is to practice seeing. So let's do just that. At this stage in your development, the biggest risk isn't missing a pattern or mistiming a breakout. It's misinterpreting the chart through the lens of your own emotions. That's why this week I want you to go deeper with your mindset. You'll read from Mark Douglas, who teaches us that trading is about consistency over certainty. From Steen Barger, who helps us confront the narratives we bring to the screen. And from Elder, who reminds us that no system, no matter how perfect, can protect us from ourselves. These chapters will help you take the tools we've built and begin the real work of internal mastery, because clarity on the chart starts with clarity in the mirror. That's it for today's lesson, and I want to sincerely thank you for taking the time to invest in yourself. This course isn't about flashy trades or quick profits. It's about building the foundation that lasts. You've now learned what technical analysis really is, not just the tools, but the mindset behind them. And next week, we take it further. We'll walk through live charting basics together. You'll learn how to set up your workspace, annotate levels, and start practicing technical vision in real time. Until then, make sure to complete your assignment, drop your thoughts in the reflection thread, and begin your daily charting routine. And if you found value in this, don't forget to like, subscribe, and share this with someone else starting their trading journey. All the links you need are in the description below. Thanks again for being part of this community. I'll see you in the next session.